Welcome back to the channel. If you've been watching the news lately, you know the financial world is on fire. Treasury Secretary Scott Bessent is on television every other day, calling the opposition to his new bill nihilists. The markets are swinging like a pendulum. Bitcoin crashes 29% one month, then rallies the next. Banks are terrified, claiming trillions of dollars are about to vanish from their vaults. And in the middle of all this chaos sits a piece of legislation that sounds boring on paper, but might just be the most revolutionary economic shift in American history. The Digital Asset Market Clarity Act of 2026, or as everyone calls it, the Clarity Act. Now the mainstream media is telling you this is just about regulation. They say it's about market comfort, about protecting investors, about stopping the next FTX. And sure, that's part of it. But if you dig into the legal text, if you look at who is fighting for it and who is fighting against it, you start to see a different picture, a much bigger picture. Today, we are going to do a really deep dive into what is actually happening in Washington right now. We are going to look at how this bill, combined with the Genius Act and the new Strategic Bitcoin Reserve, isn't just regulating crypto, it is setting the stage for a fundamental transformation of the U.S. financial system. We are going to explore the theory that the U.S. government isn't trying to ban Bitcoin to save the dollar, they are trying to co-opt Bitcoin to save American financial hegemony. We're going to break down how the blockchain maturity test works, why the banks are screaming about a $6 trillion deposit flight, and how the Tether loophole might actually be a feature, not a bug. Is the Clarity Act the death knell for the fiat dollar as we know it, or is it the beginning of a new dual currency empire? Buckle up, because this is going to be a long ride. To understand the solution, we have to understand the problem. It's early 2026. The economy isn't crashing, but it's weird. We're seeing what Coinbase calls a cautiously optimistic outlook, but there are cracks. Labor productivity is up due to AI, but the deficit is massive. And then there's the crypto market. February 2026 saw a massive sell-off. Bitcoin and Ethereum dropped nearly 30% from their highs. Spot Bitcoin ETFs, the darling of Wall Street just a year ago, bled $1.5 billion in 2 weeks. Fear and Greed Index? Extreme fear. Enter Treasury Secretary Scott Bessent. He's looking at this volatility, and he's not saying crypto is a scam, let it burn. He's saying the opposite. He's going on CNBC, he's going on Fox Business, and he's telling the world that this volatility is artificial. He says it's self-induced. Why? Because the United States has no rules. He's arguing that the market is crashing because investors are terrified that the government is going to ban everything. So, his solution is simple. Passing the Clarity Act will give the market great comfort. Now, pause for a second. Great comfort. Since when is it the job of the U.S. Treasury Secretary to comfort Bitcoin investors? This is a massive shift in tone from the Biden administration, which Bessent claims tried to cause an extinction event for crypto. The Trump administration is taking a totally different approach. They want the U.S. to be the crypto capital of the world. But why? Why does the U.S. government care if Bitcoin goes up or down? Here's the key. The U.S. government has realized they can't beat Bitcoin. They tried ignoring it. They tried regulating it by enforcement. It didn't work. Bitcoin is still here. So now they are pivoting to strategy number 2, assimilation. The Clarity Act is the mechanism for that assimilation. It's H.R. 3633, introduced by French Hill, and it fundamentally changes the definition of money in America. For the last decade, we've had a turf war. On one side, you have the SEC, the Securities and Exchange Commission. They look at a crypto token and say, that's a security, that's like a stock. You need to register with us, follow our rules, and basically act like a public company. The problem is, decentralized networks can't act like public companies. There is no CEO of Bitcoin. There is no board of directors for a truly decentralized protocol. So the SEC's rules were effectively a ban. On the other side, you have the CFTC, the Commodity Futures Trading Commission. They regulate things like wheat, oil, gold, commodities. Their rules are about preventing fraud and manipulation in the markets, but they don't require the wheat to register as a company. The crypto industry has been begging to be regulated by the CFTC. They want Bitcoin to be treated like digital gold, not digital Apple stock. The Clarity Act ends this war. It draws a bright line in the sand. It creates 3 categories: digital commodities, digital asset securities, and permitted payment stablecoins. Here's the revolutionary part: the blockchain maturity test. This is the mechanism that allows an asset to transform. Imagine if a startup stock could eventually become gold. That's what this bill does. It says that a token might start as a security when a company is raising money to build the network, But if that network becomes sufficiently decentralized, if no single person controls more than 20% of the supply or governance, it morphs into a digital commodity. It moves from the SEC's strict jail to the CFTC's open playground. Why does this matter for the dollar? Because it legally enshrines Bitcoin as a commodity. It puts Bitcoin in the same legal bucket as gold and oil. It removes the threat of the government calling it an illegal security. It gives it sovereign status. And once you give an asset sovereign commodity status, you allow the entire U.S. financial system to interact with it without fear. Now you might think, great, regulatory clarity. Everyone wins. Wrong. The banks are absolutely losing their minds, and this is where the replacement theory gets real. On February 10, 2026, there was a meeting at the White House. On one side, you had the crypto guys Cody Carbone from the Digital Chamber, folks from Coinbase. On the other side, you had the bankers Bank of America, the American Bankers Association. The topic? Stablecoin yields. The banks brought a one-page document. It was titled, Yield and Interest Prohibition Principles. They demanded a total ban on stablecoins paying any kind of interest or reward. Why? Because Bank of America CEO Brian Moynihan dropped a bomb. He warned that if stablecoins are allowed to pay yield, up to $6 trillion could flee the commercial banking system. Let that number sink in. $6 trillion. That is a run on the banks, the likes of which we haven't seen since the Great Depression. Why would money leave? Because of efficiency. If you can hold a digital dollar, a stablecoin on a blockchain that pays you 4% or 5% interest derived from Treasury bills, and you can move that money instantly, 24/7, anywhere in the world, why would you keep your money in a Bank of America savings account paying 0.001% that is closed on weekends? The banks know they can't compete with the efficiency of the blockchain. Their entire business model relies on sticky deposits, paying you nothing for your money and lending it out at 7%. Stablecoins break that model. They pass the yield from government bonds directly to the user. This is the replacement in action. It's not that the government is going to confiscate your dollars and give you Bitcoin. It's that the Clarity Act, by legalizing stablecoins and digital commodities, creates a parallel financial rail that is simply better than the legacy system. The banks are terrified that the dollar banking system will be replaced by a dollar blockchain system. And once people are on the blockchain system, the jump from a digital dollar to Bitcoin is just one click. This brings us to the Genius Act. This bill, which stands for Guiding and Establishing National Innovation for U.S. Stablecoins, has already passed. It sets the rules for who can issue these digital dollars. It requires them to be backed one-to-one with safe assets like Treasury bills. Now, critics like those at Americans for Financial Reform call this a disaster. They say it creates a shadow banking system. But look at it from the Treasury's perspective. Look at it from Scott Bessent's perspective. Who buys U.S. debt? Who buys Treasury bills? China is buying less. Japan is slowing down. We need new buyers for our debt to keep the dollar strong. Stablecoins are massive buyers of U.S. treasuries. Tether and Circle already hold more U.S. debt than many G7 nations. By regulating stablecoins and encouraging their growth, the U.S. government is creating a new, infinite buyer for its debt. They are using crypto to prop up the dollar. But there is a catch. The Tether loophole. Anti-corruption groups are screaming about this. The Clarity Act regulates U.S. companies. But what about offshore companies? What if an American buys a stablecoin from a secondary market that was issued in the British Virgin Islands? The bill has gaps, and some argue these gaps are intentional. They allow the dollar to spread globally via crypto rails, bypassing sanctions and local controls in other countries. It weaponizes the dollar via crypto. However, the Digital Chamber is fighting the banks on the yield ban. They released their own principles. They said, okay, we won't pay interest on idle stablecoins like a fake bank account, but you have to let us pay rewards for active participation. They want to preserve DeFi. They want to preserve the ability to earn yield by providing liquidity. If the crypto lobby wins this fight, and with the Trump administration calling the blockers nihilists, it looks like they might, it means the $6 trillion migration begins. Money moves from banks to blockchains. And once it's there, it doesn't just sit in stablecoins. It flows into the apex asset, Bitcoin. Now we get to the most sci-fi part of this whole saga, the strategic Bitcoin reserve. For years, when the U.S. government seized Bitcoin from criminals Silk Road, hackers, etc., they auctioned it off. They sold it for dollars. But in 2026, policy changed. Secretary Bessent confirmed it. The U.S. government is no longer selling, they are holding. They currently hold over $15 billion in Bitcoin. Senator Cynthia Lummis wants to go further. She wants the U.S. to actively buy Bitcoin to reduce the national debt. The idea is that Bitcoin will appreciate faster than the interest on the debt accumulates. Think about what that signals to the market. The U.S. government, the issuer of the world reserve currency, is holding a rival currency on its balance sheet. They are diversifying out of their own fiat. They are admitting, implicitly, that the dollar loses value over time, while Bitcoin gains it. This isn't replacement by decree, it's replacement by game theory. If the U.S. government holds Bitcoin, then other nations must hold Bitcoin to hedge. If other nations hold it, corporations must hold it. We see this happening. The 2026 Crypto Market Outlook from Coinbase notes that corporate treasuries are accumulating Bitcoin. We are seeing a shift where Bitcoin becomes the pristine collateral of the global financial system, replacing U.S. treasuries in that specific role. So, how does the Clarity Act facilitate this replacement for you, the average person? It's about access. Right now, or at least prior to 2026, big institutions had a hard time touching crypto. Custody was a nightmare, accounting was a mess. But the Clarity Act solves custody. It allows banks to hold crypto. It allows broker-dealers to hold crypto. We are already seeing the effects. Bank of America, the same bank terrified of deposit flight, is now allowing its 15,000 advisors to recommend Bitcoin ETFs. They are advising a 1% to 4% allocation. Morgan Stanley has launched a Solana trust. The K&L Gates legal analysis calls this the democratization of digital assets. It means that crypto is no longer a fringe asset for tech bros. It is part of the standard 60-40 portfolio. It is being integrated into 401ks thanks to President Trump's executive order on democratizing access to alternative assets. When you put Bitcoin in every 401k in America, you effectively monetize the debt through asset inflation. But you also make the dollar secondary. You make the dollar the transaction currency, but Bitcoin the savings currency. You get paid in dollars, but you save in Bitcoin. This is the dual currency system I mentioned earlier. The dollar doesn't disappear, it just becomes the hot potato you spend, while Bitcoin becomes the vault you lock away. It's important to note that this isn't a done deal. The political pressure is immense. The Treasury Secretary is warning that if Democrats retake the House in November 2026, this all falls apart. He's telling the industry to get in line now or risk losing everything. The opposition is fierce. You have the nihilists in the crypto industry, purists who think any regulation is bad. They hate the surveillance. The Clarity Act essentially kills anonymous DeFi. It requires protocols to register. It brings the Eye of Sauron onto the blockchain. Then you have the consumer protection groups. They say this is a disaster waiting to happen. They say the CFTC is too small and underfunded to police the crypto markets. They say this bill is a get-out-of-jail-free card for fraudsters. And of course the banks. They are fighting for their lives. If they lose the ability to ban stablecoin yields, they lose their monopoly on savings. So, will the Clarity Act replace the US dollar with Bitcoin? Not directly. You won't be paying your taxes in Bitcoin next year. You won't be buying milk with Bitcoin at Walmart, you'll be buying it with a stablecoin backed by dollars. But in the long term, the Clarity Act accelerates a trend where the dollar loses its status as the exclusive store of value. It opens the floodgates for capital to leave the fiat system and enter the digital asset ecosystem. It creates a legal framework where Bitcoin is treated as a sovereign commodity, equal in status to gold, and superior in utility. The US government is making a bet. They are betting that by regulating Bitcoin and bringing it onshore, they can control it. They can tax it, they can surveil it, and they can use the stablecoin market to prop up the treasury market. But Bitcoin is slippery. By integrating it into the heart of the financial system, they are also exposing the dollar to direct competition. They are allowing the American people to vote with their wallets. And if the banks are right, if $6 trillion really does move to the blockchain, then the market has already made its choice. The Clarity Act doesn't kill the dollar, it just forces it to share the throne. And in the Game of Thrones, we know what happens to those who share power. Thanks for watching. If you want to track the bill's progress, check the links in the description. We'll be covering the Senate markup next week. Don't forget to like and subscribe.